Can Taxes and Bonds Finance Government Spending? By Stephanie Bell. Section 1. Introduction. The optimal method by which to finance government deficit spending remains a controversial topic among many economists. Although most would agree that government financial policies require choosing among the imposition of taxes, the sale of interest-bearing debt obligations, and the creation of government money, or some combination of these, there is often strong disagreement regarding the macroeconomic consequences of these choices. Footnote: government money will be used to refer to high-powered money, HPM, defined as member bank deposit balances at the Federal Reserve, plus total currency outstanding. When necessary, changes in the money supply, M1, M2, etc., will be distinguished from changes in HPM. The Barrow-Ricardo thesis, for example, suggests that the financing choice is inconsequential. This, it is argued, is because the knowledge that bond-financed government spending will require higher taxes in the future induces households to save more now. The induced saving, which is just sufficient to purchase the new government debt, leaves private net wealth unchanged, thereby completely neutralizing the stimulative effect of government spending. Similarly, as Tobin recognizes, spending financed by issuing demand obligations, that is, printing money, might lead a monetarist Ricardian to suggest that a money rain, like a bond rain, will have no effect on aggregate private wealth or consumption, since adjustments in the price level will prevent the real quantity of money from changing. Thus, bond or money-financed deficit spending yields results equivalent with those that would have resulted if all spending had been financed by contemporaneous taxation. In contrast, some Keynesians maintain that choices concerning the sources of deficit finance are indeed relevant. For them, the economic consequences of borrowing and printing money can differ substantially from those obtained when government spending is financed solely by contemporaneous taxation. Among members of this group, most would probably agree that printing money is both the least common and the least desirable method for financing the government spending. Indeed, most would probably say that bond sales are, and should be, used to finance the excess of spending over taxation. Despite differing beliefs regarding the consequences of the financing decision, both groups clearly believe that the government does choose how to finance its spending. What is conspicuously absent in these ongoing debates, however, is a detailed examination of the nuances of reserve accounting. Because these nuances have not been incorporated into standard analyses, many economists continue to debate the macroeconomic consequences of alternative financing methods. These debates follow directly from the apparent interdependence among taxes, bond sales, and deficit spending. By considering the impact of these operations on bank reserves, their interdependence can be explained as a consequence of their reserve effects, rather than as necessary financing relationships. Thus, this paper closely examines the reserve effects of the Treasury's operations by tracing through the impact of government spending, taxing, and bond sales on aggregate member bank reserves. Section 2 details the impact of government spending and taxing on bank reserves, as well as the significance of the resulting reserve effects. In Section 3, some important strategies for minimizing the reserve effects are introduced. The case of deficit spending is taken up in Section 4, where the reserve effects of various methods for the sale of government debt are examined. In Section 5, the complexities of reserve accounting are carefully considered, and newly created money is revealed as the source of all government finance. It is further argued that the proceeds from taxation and bond sales are not even capable of financing government spending, since their collection implies their destruction. In the concluding section, it is suggested that debates concerning alternative methods for financing the government's deficit spending should, instead, be debates about alternative means of draining excess reserves from the banking system.